I think they're very, very low for various reasons. Number one, the US Fifth Fleet is not a million miles away in the region. And for Iran to blockade the strait in some way, shape or form will be economic suicide. It relies on oil exports. Its biggest customer, and indeed its only big customer, is China. And it has long-term supply arrangements with China at advantageous prices, so the Chinese won't be very impressed. And indeed, China is Iran's biggest trade partner overall. You also have the fact that prior to the outbreak of hostilities, Iran's relations with Saudi Arabia, the UAE, and one or two other countries in the region had been improving. So to take action which would block the Strait of Hormuz, which would affect not just Iran, but also Saudi Arabia, UAE, Iraq, Kuwait, Qatar, left anybody out, I think that would be economically suicidal for Iran. And the US is not going to let that happen, because if it did happen and prices did spike to the educated guesswork levels that Goldman Sachs have come up with, that is disastrous for the global economy, and that would not stand.
Disastrous for President Trump specifically when inflation has been muted in part because of the lower oil price. So if we take that option off the table, the so-called sort of Trump card from Iran's perspective, what else could drive oil prices higher from here? What should investors be thinking about, worried about?
Well, if there is no blockade and it is essentially business as usual, and that's what we have seen so far since the Israeli attacks on Iran, then the fundamentals of the oil market remain the same. Growth is very tepid, partly because of the uncertainty caused by Trump's tariff policies. And on the other side of the balance, we have plenty of supply coming on stream during 2025 from the US, from Canada, from Brazil, from Guyana, from Argentina, and of course we've got the OPEC plus voluntary cuts being unwound. So we've got tepid demand growth, but plenty of supply. Absent a massive supply shock, we should see oil prices come off from the geopolitical peak that we've seen in the last few days, and certainly for Brent, head back down into maybe the high 60s.
Neil, the level that you mentioned for Goldman Sachs, if there was a prolonged conflict or any closure in terms of tanker traffic, $100 on Brent prices, that's the level we could spike to and beyond from. In terms of the global economy, it feels as though there have been multiple threats, and an oil shock would just come on top of everything else that we've been dealing with. What does that do in terms of the demand for oil? If we went from an oil shock story, how deeply would that dent demand?
Oh, if we went to a $120, $150 a barrel world, and this really is educated guesswork, because we've never been in this situation before. We've had short-term problems with the Gulf War, the invasion of Iraq, and other examples. But if we were to do that, we would see oil demand growth come off even further. So it isn't difficult to see a situation where demand growth this year of about 800,000 barrels a day currently expected could at least halve down to 300,000 or 400,000 barrels a day if oil became significantly more expensive.